For some reason, our intro music and countdown are not working, so I'm hoping that you guys can actually hear me, but StreamYard's having an issue. But we'll go ahead anyways and just launch. So guys, listen, a lot of people in 2021 pointed to the beginning of the summer bear market, the catalyst of that being the fact that Tesla decided not to accept Bitcoin anymore for their cars. Now, we all know it's much deeper than that, and that was just a small thing. But now, once again, we have some Tesla news in the midst of a bear market that everybody seems to be discussing. They sold 75% of the Bitcoin that they held to pad their balance sheet with cash and improve their quarterly earnings. We're going to talk about whether that's important and matters at all, or whether it's not a big deal. Also, of course, we're going to discuss everything going on with Three Arrows Capital and Celsius. I've got an incredible lineup today. David Duong from Coinbase, Simon Dixon, Mike Alfred, and Joshua Frank. You guys do not want to miss this. I'm going to say let's go, then I'm going to...
Let's go. Let's go.
Well, that worked. That worked. Surprisingly, the countdown didn't work, but we did manage to get the intro music there to work. And I know that that's been stuck in your head probably for 3 years now. So you're welcome. You guys can have that trumpet stuck in your brain for the next few hours. Now, guys, as I mentioned today, I have another epic roundtable. We're just going to dive directly right into it. I've got David Duong, Simon Dixon, Mike Alfred, and Joshua Frank. And apparently we can all still fit on this screen with 5 of us, which is awesome. Thank you guys so much for joining. I know for some of you, it's odd hours to be here, and we appreciate you either waking up or staying up late to do this. Now, as I mentioned in the intro, guys, Tesla seems to be the big news of today. So just going to launch right into it. Does it even matter anymore what Tesla does with their balance sheet and with their Bitcoin holdings? Anyone who wants to jump in, have at it.
So,
all right, I'll take it.
Yeah, go ahead, Simon. You go first.
All right, cool. So, you know, it's the public companies and Bitcoin have been really one of the catalysts for the last bull market. So started by Michael Saylor, you know, implementing the Bitcoin standard strategy, you know, in an environment of hyperinflation or inflation in around the world. So market sentiment matters. People interpret it differently. But as with all things, it's about following the money and understanding the flow of funds. So just because Tesla's selling, it doesn't necessarily mean that was dumped onto exchanges or anything. You know, if you look at the flow of money that we don't know, the publicly traded companies obviously have to do full disclosures. But prior to this, there was activities where Elon Musk was selling his Tesla shares, and he publicly disclosed that. And disclosures become important for the next conversations on Celsius, but publicly disclose that. And then, you know, there could be an OTC trade where he dumped his Tesla stock in order to buy some Bitcoin, where it went from Tesla to Elon. We don't know the answer to any of those unless it was done on Coinbase's institutional desk, which you obviously wouldn't be able to disclose anyway for client privacy and confidentiality. So as always, it's a flow of funds that matters. Now, whether they're, you know, this is one of the challenges at Bank to the Future. We've always held a Bitcoin balance from the beginning in 2010 since we started. And managing, making sure you have enough dollars to cover your operational costs in a business is obviously very important, and separating your operational cost from your savings, and the savings being in Bitcoin, it requires a bit of cash management. But when you have disasters, you have to manage, you know, they've got a highly accomplished CFO that will be managing what levels of balances they need to recover from the COVID shutdowns in their China plants and stuff.
Yeah, so my view
I would say that, you know, go ahead, Mike.
Yeah, so real quickly, my view on this is that Elon selling Bitcoin says a lot more about Elon than it does about Bitcoin. This corporate treasury issue has sort of been a dead issue in the space since like the spring of 2021. Like there aren't that many large corporates that have been acquiring Bitcoin. Elon has a long history of managing earnings and in my view, committing securities fraud. So selling Bitcoin to manage earnings is just another thing in the line. And I don't think Tesla has an accomplished CFO. I mean, the CFO was like 30 years old when he was put into place. I think Elon likes having people that are less experienced in that type of role. Normally, you'd want to see somebody who's a bit more seasoned. But, you know, continuing to manage earnings makes a lot of sense for a company that's overvalued. I mean, Tesla has been trading probably 2, 3, 4 times higher than it should be trading. At any point, if any sheen comes off of this company, like the stock can go down 80-90%, even in a flat market, in my view. So I think it's just another example of him manipulating the market, manipulating the stock, and manipulating earnings.
David.
Oh, I was just going to say that I have no visibility into what these transactions were, OTC or otherwise. They don't pay me enough to know. But I mean, even if I wanted to comment, I couldn't because I just don't know. I would say that right now, I think there was a lot of press around the liquidity needs surrounding Tesla last month. So, you know, we saw that this is, of course, a Q2 filing. And so the 75% of Bitcoin that was sold actually already was been done. It kind of ended in June. So in some ways, I think that ex post kind of behavior isn't necessarily relevant, except for the fact that we know that positioning is a lot cleaner now in the market. And we know that given the battles between Tesla and Twitter and you know, the acquisitions that it was trying to make on that side that ultimately failed, that probably this could be behind some of that in terms of some of the needs that they actually had to fulfill. So I think that when he says he hasn't necessarily, like Elon says that he hasn't necessarily changed his view on cryptocurrencies, that he still remains positive, and that this wasn't why he was selling the Bitcoin, I kind of take him at his word on that. Also, I just think that after the kind of move we've gotten, now we're in a better position for cryptocurrencies in general. So I think at the very least, now we know at least who the big seller was in the last few months.
Yeah, look, I mean, I think when we've seen this with crypto companies as well, there have been a lot of crypto companies that have tokens on their balance sheet and they're screwed. Right. You know, the job of a public company isn't to operate as a hedge fund, right? Like, I do believe that in the long run, Bitcoin will go up. I'm in this space just like all of you guys are, right? I think there are arguments for Bitcoin. And I think, you know, some of the risk off arguments make sense. Others necessarily, you know, don't necessarily make sense. But at the end of the day, like, they have a business to run. They need cash, right? And so they moved to cash, right? You know, their Bitcoin, I mean, they lost a little bit on it. I mean, it didn't lose, you know, they didn't lose billions of dollars. They lost, I don't know, 100 million or whatever the number was on that position, right? So at the end of the day, you know, there's, you know, I think Mike made a great point. Like, no one else was doing this anyways, right? You know, sure, Michael Saylor did it. A couple people bought $5 million of the Bitcoin to get some press when, you know, most of these companies, though, are like dead, you know, shell, crappy public companies. You know, they're $200 million businesses that bought a few $1 million of the Bitcoin, right? They're not massive companies. And so I think, you know, this is kind of just done, right? I think, like, we had that little Michael Saylor conference in charade, you know, why a corporate treasury should hold crypto. A couple people went out and bought it. And this is kind of the end of that. And it's crypto. And so, you know, narratives last 3 weeks. And so it's time to move on to the next narrative.
There's a few key things that you guys mentioned here. Obviously, the fact, Josh, I think what you just described is a lot of the reason that we've seen sort of the sell-off is that obviously it's a liquid asset. It's 24/7. And when a company needs liquidity or when a person needs liquidity, it's obviously the first thing that they look to sell. But also what David said, which is that the market is now positioned. We know better where all these players are. So that leads to the next idea, which is to figure out whether this contagion is done, right? It seems obviously we started with Luna and then we felt, hey, there's no contagion, but we saw 3AC and Celsius and Voyager. Are we now sort of at the tail end of that? I mean, a lot of times you see that kind of news at the end of a bear market cycle, not at the beginning. Or do you think that there's more still yet to come?
I think we've got a much better inventory now of where the contagion risks were. I mean, as we're recording this on July 21st, we still heard about ZipMex overnight. And, you know, so there are still situations that are rising, but I think we're, you know, managing the aftershocks pretty well as an industry. So now we know, all right, Celsius had, like, you know, the 4.5 sitting on its assets, 4.5 billion, the 5.5 billion sitting on its liabilities. We know about how much the $3.5 billion in loans that 3 Arrows Capital had, and that one of its biggest creditors was Genesis. So I think these things are now public information. So at the very least, you know, it's been a fairly long list, but the level of liquidations we've gotten at least has now seen that the excess risk has been flushed out of the system. Most people are aware that these were credit risks, not crypto risks. So if you're in the traditional finance industry, this is very recognizable to you in terms of the risk management that was poorly done, similar to what we saw in the 2008 financial crisis, for example. So my guess is probably the worst for crypto is probably over at this point, but that's still a separate issue from the idea that we're going to recover. I still think that we need a period of stabilization, but that's very dependent on the macro environment. And that's going to depend on what happens on July 27th with the Fed, for example, what's going to happen with the large cap names are reporting and the earnings forecast that they have. Plus, we've got a couple of important things coming up next week, even just in terms of the options expiry at the end of next week, as well as a stablecoins bill that's coming out.
Yeah, I mean, I think the worst of what we know is done, but I still think there's more things that can still happen, right? I mean, there are a lot of funds that are down 70, 80, 90% from their high watermark, and depending on how they return funds to their, to their LPs, if LPs ask for funds back in the underlying assets, if they want cash, right? So I think that there are still more things that can happen, and it's crypto, which means there's always more things that will happen. You never know, right? I mean, there's so many hacks, there's so many other things, but I think from these, these major liquid, or I guess, this major kind of, impact of all this lending is probably mostly done. But I still think there's, look, when the market crashes 70 to 80%, there's a lot of things that happen. There's a lot of things that will shake out. I mean, we haven't really heard of any, we have about 150 institutional clients. We only know of 2 so far that have officially returned funds back to their LPs. And I still think there's going to be more of that coming.
Yeah, the other area to watch, Scott, is the Bitcoin miners. If Bitcoin were to stay under 20K for some prolonged period, or even at this level, right, like in the kind of low 20Ks, there's going to be a lot more distress in the Bitcoin mining space because a lot of the miners out there today just aren't profitable at these levels. So I think, most people are modeling Bitcoin coming back up to 25 or 30K. But if that were not to happen for some reason, even if we were just to languish at this level for 6 or 9 months, there may be a handful of large, even publicly traded miners that would go out of business. So that could be another area of distress here if this were to continue. But I generally agree with the previous comments that, at least as it relates to the lending space and the asset management space, like most of the distress is over. Celsius was the biggest and most irresponsible player in the entire ecosystem, in my opinion. That's been my opinion for more than a year. And so them kind of going into liquidation essentially should mark at least a short-term bottom in my view.
The answer to that is the outcome of the Chapter 11. So at the moment, we've got Voyager and Celsius in Chapter 11 looking to do a reorg. They haven't liquidated. We know the size of those balance sheets, so there's the potential for multi-billion-dollar liquidations if the reorg doesn't happen. So the outcome of those reorgs will determine, and then that will expose some of the other trends that we're talking about. So the mining companies are suffering right now. Interestingly, on Celsius' balance sheet is a mining company as well. So the outcome of the reorg will determine the next effect that will then trigger whether there's some of those liquidations in DeFi contracts. And so really the short-term price and whether this is dependent upon the outcome of those different things. And that really is in the hands of the people that are going to be determining, the committee members that are going to be determining, is there a reorg that means that you don't need to liquidate, or is this going to lead to liquidations? And there's still lots of unregulated exchanges that haven't revealed their insolvency positions. There's still lots of really shitty positions and people hiding the fact that they are fractional reserve banks. Whether that get exposed or not depends upon the outcome of these Chapter 11s.
Just be a little bit careful when we talk about the Bitcoin miners, and I'm not trying to necessarily defend that, because we did see that they went really from raising capital via equity into borrowing, in part because there was so much competition among these lenders that they found that opportunity in Q4 2021. But we did some digging in terms of how much reserves they're actually sitting on. So year to date, they sold somewhere around like 13,000 Bitcoin out of their reserves. They still have, among the publicly traded miners, around 55,000 Bitcoin. That's according to Coinmetrics. So that's still a fairly sizable position. of course, we've seen the headlines with Bit Farms, and they changed their strategy from hoarding to selling into the market. Marathon, of course, had some unfortunate incidents at the end of last month in terms of some of their machines actually going offline. But, if you just kind of do a back of the envelope calculation, like just fairly conservative numbers, they probably would need to sell, assuming that Bitcoin stays around the 20,000 levels. And of course, today we're trading above that, probably around like 3 Bitcoin a day to stay solvent. So, if it drops to, 10,000, let's say, then of course that's going to go up to maybe 16 Bitcoin per day and becomes more problematic. But that still means that they're probably able to stick around for another 6 months. So there's going to be time. But I'm not disagreeing with you, Mike. I think that we probably will see some consolidations in the future among some of these Bitcoin miners. Some of them are still going to find their finances strained. I'm just saying that we need to kind of put things in context.
Well, plus it relates to, so Celsius's recovery plan is to pay off, try and fill some of their hole through mining. And so if there ends up with a weird dynamic where they have to liquidate the crypto positions, then that ruins their recovery plan in the mining operation. And then they'd have to wait for difficulty adjustments. So there's some really interesting dynamics that come out of that.
I mean, the Celsius plan seemed a bit
well, of course, we
ambitious.
Trust them, right? I mean, all their plans are great. So
yeah, right. But I mean, right? They're mining. They're currently
their recovery
mining
plan is, is as good as their risk management before the recovery plan.
They're also going to go buy scratch-off tickets with all the STETH they converted to ETH and see what happens.
But I mean, they're mining like 17 or 40, something ridiculously low number of Bitcoin right now. They need money from the Chapter 11, like from the judge, basically, to go finish their mining facility. And their recovery plan is based on mining 15,000 Bitcoin or something, right? I mean, that seems
people,
like unicorn.
People are doing, back of the fag packet calculations on not realizing that there's an incredible amount of cost. It's a low margin business. I was doing mining in 2014. It's a constant reinvestment business, high capital expenditure, constant reinvestment, and just low margin. You have to be really, really efficient at that. And really, the good old debate in Bitcoin mining has been as old as since we were first podcasting, which is it worth doing the mining versus what if you just bought the Bitcoin and didn't have all that expense? And those differentials only last when Satoshi created a very efficient difficulty rate adjustment that takes out some of those shorter term profits. Excuse me.
I mean, that mining cycle, the mining cycle of miners being washed out, mid halving is nothing new, right? I mean, even bear market aside, it's not like every miner survives every single cycle. I mean, it's sort of the nature of the business, right? I mean, Mike, is that accurate?
Yeah, that's right. But I do think there's a lot more distress than David just said. And obviously, I'm on the board of a publicly traded miner, so I have to be careful what I say because I'm obviously seeing things in the market that may not be public information yet. But my view is just that the Celsius plan is crazy. There's so many supply chain issues, right? There's so many issues just operationally. Like Marathon did just have issues last couple of months. They've had issues for more than a year, right? They were supposed to have 132,000 machines plugged in this month, and they've got like 30,000 machines plugged in. They can't keep them plugged in. They can't keep their power on, right? And so the idea that Celsius, who clearly has no idea how to run a mining business, is somehow going to deliver this back to the depositors is absolutely crazy. Like the judge, if they approve a plan that allows Mashinsky to continue to run miners, is hurting the depositors irrevocably, in my opinion. I think that person should be shamed out of the courtroom because that's a really bad idea in my view.
Simon, what does the Celsius Chapter 11 mean for the reorganization plans that you were presenting?
So since my life got turned upside down by Celsius when they suspended withdrawals, I kind of went through 3 phases, and we're on the 3rd phase. The first was that we wanted to put together a recovery plan similar to what we did for Bitfinex in 2016, where we used a combination of debt and equity and security tokens in order to get the company back on. That was an incredibly successful recovery plan. It was high risk, but the equity holders ended up with equity at 30 cents that ended up at $16. And they ended up with hundreds of millions of dividends and a right to the recovery of the hat Bitcoins that came back this year. So we tried to do that for Celsius, but it turned out that there was an incredible amount of things that were needed to be hidden that came out in the Chapter 11. So we moved on from that swiftly and went to the second plan, which is where we put together a syndicate of investors that were willing to plug the gap. It required transparency on financials and transparency on regulatory disclosures. And it turned out that there was a massive amount of mismanagement of finances. And then all of the misrepresentations of the leadership came out, where they were telling people that this is guaranteed on the sell token. And then they were putting up buy walls in the sell token, selling against while going on publicly, telling people they should buy sell token while the CEO was selling sell token. Allowing people to use sell token as collateral so that they could take out a dollar loan and then buy more sell token. And really everything that people were trying to expose, that people, everyone was being accused of FUD for kind of exposing that in the end helped a lot of depositors withdraw before those that weren't able to withdraw. So then we moved over to 3, which is the third proposal was putting together a company that we've got the different licenses. So in crypto lending, there's 2 parts to it. There's a security, which is offering people yield as an investment product. And then there's lending, which requires a consumer credit license in order to responsibly change the leadership so that it was a culture of not misrepresenting, and put together a new risk model, which is Bitcoin as collateral, managing volatility and only stable coins, and take out all the shit and everything else. So we're currently at the phase of proposing a Bitcoin investment bank that has leadership, risk management, and all of the regulatory permissions as a recovery plan. So that's where the Chapter 11 is. And if that doesn't get accepted, then it's over to one of Celsius's crazy plans. And if that doesn't get accepted, then it's liquidations, and we move to the next phase of exposing all the other businesses as well.
What a shit show.
Yeah.
Josh, I see you shaking your head.
I was gonna say I don't want to follow that one up, so I got
I mean, but I listened to that, and it's incredible what you're trying to do. Plan 2 is what got me, right? Putting together a syndicate basically to fill the gap and bail it out. And listen, everybody here knows that I'm one of the larger creditors for Voyager as well, right? And so I would love to see these gaps filled and people paid out. But it does beg the question on what business is left, even if somebody comes in and fills the gap. I mean,
also,
is there enough consumer confidence? Like, is there enough consumer confidence in any of them that they're viable businesses, even if the gaps are filled? And that's to my own detriment to even say that, of course.
Yeah, I mean, I think to add to that, so one of the lenders, I don't want to talk about who it is, sent an email, or I think it was public, sent an email to most of their customers, say, get on the phone with me and let us talk about why you should trust us to keep your money with us, right? And it went from the point of, everyone wanting to deposit on these to actually having to hire people to, make calls to say, please, 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 trust me, keep 25% of the amount of capital that you had with me. So I think the overall trust in lenders is got to be way down. And I think the thing that's really unfortunate to this industry is it was so many average people. It was so many Uber drivers. It was, your barber. It was, your cousin. It was average people that lost a lot of money here. And it just is a really bad reflection on the industry.
Yeah, no, definitely. And this is the heartbreaking part of this one. The 2017 ICO boom and bust was really just a bunch of people trying to get rich quick, and speculating on exchanges and getting wrecked. Fine, learn your lesson, move on. You exit the market if you try to get rich too quick. And those that believed in Bitcoin carried on and started building. But this time was really different. It was a CEO that deliberately misrepresented the risk profile of taking your savings out of a bank, taking your retirement funds out of a retirement plan, and then putting it into a high-risk hedge fund that turned out to be a fractional reserve bank that he represented was guaranteed on a $2 billion balance sheet when the funding round never raised as much as they said it was, when it said that it was not taking risk and less than 5% of it was in DeFi, stating that it is safer than a bank and debanking yourself. And a lot of people, these aren't DeFi degens or those types of people. These are people that took the dollars out of their retirement accounts, didn't really understand the dynamics of a stable coin, but were just receiving higher yield because of a promise that this was safer than a bank, and representations that the CEO would guarantee if anything went wrong. It's a really, really disgusting scenario that has led to suicides and deaths. I'm getting messages like that because there are people right now that have lost their entire retirement at a time when there is, inflation and financial uncertainty, increasing interest rates while people are unable to pay their mortgages. This is not a good look. This is a disaster. This is really very different to what happened in 2017 and 2018.
I think one thing we need to do a better job as a crypto industry, and I give Mike actually a lot of credit because I've seen him do this on Twitter. We all knew there was problems with Celsius and people just didn't speak up. Like, I was on a panel with Alex at Bitcoin Miami in April, and it was about generating alpha on Bitcoin. And it was me and the president of XBTO and the CEO of Off the Chain Capital and Alex, and we were all like, it's really difficult. There's not much alpha anymore. It's hard to find alpha right now. And Alex was literally on stage saying, don't listen to these guys. We're the largest holder of Bitcoin. Trust us. We take advantage of these guys to get the yield. We get it through mining and stuff. I mean, just like, I watched like in awe in April with like an open mouth as a retail audience in the crowd cheered this on. And afterwards we just gathered up and we were just like, what the did we just listen to? Like, are you kidding me? And you just don't want to start fights, but at the same time, like, I think we need to do a better job of the industry. Just like when people are clearly, spewing garbage, like, we know that there was no way to generate the yields that they were promising. It was just impossible. There was no possible way they were doing it without taking risk. I mean, I was asked by their team which hedge funds they should invest in at one point. Like, I mean, it's just like, I think we need to do a better job. And I give Mike a ton of credit here. Like, I think we need to do a better job of just calling out this bullshit, because it was clear to people in the industry that this made no sense.
Yeah, I agree.
Yeah, but I mean, look, Mike will talk to this. Yeah, when I suddenly came to my realization, and I was full of conflicts. I'm one of the top creditors to Celsius, so I had one of the top accounts there. I knew from my perspective, it's a small percentage of my net worth. So I'm not in the same position where I had 100% of my net worth there, which some people are in. And I was a shareholder in the company. But when I started to realize this, I was full of conflict. It was a very challenging situation. But once it was known, I had to come out, and you get crucified. I got completely tarnished by the community. FUD this, you're causing a run on the bank. It's all BS. And Mike was ahead of that curve as well. So I'm sure when Mike did it, it was it's very easy to get caught on, because the social media consequences of calling something out. Maybe Mike could speak to it. You really get crucified. You have to have some. Yeah, you have to be really stick to your grounds on that.
Yeah, I mean, I actually got more shit from Cardano and Hex people than I've ever gotten from Celsius folks. It helps to have thick skin. Like, I really honestly could care less what most people think about me, and I know everyone says you're not supposed to care, but the reality is most people do, and I candidly don't. The other thing is just incentives. It's hard to be highly placed in this industry and not have reasons why you can't talk, right? So like when I was at NYDIG running strategy and M&A, I knew everything about like every M&A deal that was going on in crypto, but I couldn't say a word about it. Right now, I know a lot about what's happening in the mining space because I'm on a publicly traded board, and there's things that I've signed an NDA for that I literally can't discuss that I already know are happening right now. And so that's the challenge, right? Like the people who oftentimes know the most can't say anything. They're fund managers. They can't piss off their portfolio companies. They're CEOs. They can't piss off their board or their other constituents. And so I've been an investor. I've been a CEO. I know how to think through the issues from those perspectives. But as of right now, I'm completely unemployed, right? I'm just getting paid as a board member, right? And so I have some conversations with the Iris team about this, right? Because there's some things I say on Twitter that they prefer I didn't say, but the reality, as long as I don't break any rules or laws, I'm allowed to say essentially whatever I want. But I think that's the challenge. There are very few people like me who have both the knowledge of what's happening in the space and also the latitude to speak publicly about it.
I think that's totally fair.
We're kind of disincentivized to actually speak up about these things. I mean, it's not just in crypto. I mean, I think this kind of goes for anything, frankly. It's just kind of a human concept that if people love something, we don't necessarily want to discourage them from actually talking about it. But I think, to points that Josh and Mike and Simon made, certainly I think what we will need to train people to do in the future is to be skeptical. Like if you are getting a rate that is materially higher than comparable products, either in the TradFi or DeFi space, maybe there's a risk there that you aren't anticipating. And I think we aren't going to see the end of financing or lending in this space. I just think it's going to be done differently. And it's going to need to be done with cooler heads, people who are going to conduct much more rigorous due diligence, more stress tests, look at maybe some regulatory changes that are going to change how capital ratios should be thought of, for example. Because, frankly, it's just a matter of thinking, hey, how do things go wrong here? That's really all it takes to understand, like, how to protect yourself and how to get there. But it's easy to say, hard to do. And I think that probably going forward, that's going to be what the space needs to do in order to just be better.
It's easy to say in a bear market, but really hard when everybody starts FOMOing again and freaking out in a bull market and human greed kicks in and everybody repeats the exact same mistakes. But to your point, there's no question that the lending markets will continue to exist. The question is, will retail yield continue to exist? Or is that model now finished? Anyone can feel free to jump in.
So I mean, like my quick view on that is that there are lower yield, safer ways to do this, like call writing, right? Where you give up like a small part of your upside in a upside scenario for additional income. That's a well proven strategy that works in traditional markets, and firms like NYDIG were doing this whole time at like a mid to high single digit return, and that seemed reasonable. It was the 18 and 20 and 29% type yields that were obviously suspect from the beginning, especially in an environment of essentially zero rates in the traditional market. So that's what I would be skeptical of. I think you can get a mid to high single digit rate, but again, you still end up needing to trust a counterparty if you custody your assets with somebody. So I think people just need to be aware that you have to be able to do like the forensic work to understand the balance sheets, to understand the attestations or the audited balance sheets that you can see from some of these firms, to understand the risk you're taking, because you're not getting that yield for free no matter who you use.
But retail never.
Yeah, and there's also the next wave of layer two, innovation on top of Bitcoin. So there's a lot that has been learned from what happened over the last few years, and there's a lot of slow and steady building that's been happening on top of Bitcoin. So there's all the exciting things to come that can be built on top of that, and all the companies that are looking for the next wave of layer 2, layer 3 on Bitcoin as well.
You know what I find to be sort of an interesting challenge here is that obviously we have the not your keys, not your coins ethos, and we say to people now, you need to get your money off of these platforms, which I agree with, by the way. But historically, when people who don't understand self-custody, retail goes and self-custodies, they're usually their own single point of failure. And that's another risk that they'll end up losing their assets because they don't even understand how to self-custody. So isn't all of this like sort of boil down to a certain level of personal responsibility or even community responsibility for educating? Because both of those have major risks for somebody ending up with no access to their funds.
Yeah, the answer to that is risk management. I manage my risks by having, my core stack is owning the keys, but I have a percentage at which I think about different risks. So what if I lose that key? Well, then you have multiple keys set up. What if I lose, what if I get ransomed for all those keys? Well, I'd want a custodian. What if my custodian blows up? Well, I'd want, and you just work through different risks. And Unfortunately, the world is terrible portfolio managers and terrible risk managers, which is why even the pension industry exists in the first place, because people just need somebody else to manage all those things. And I don't think we can change. You know, if you look at everything that's happened in the crypto market and the Bitcoin market, it's just a repetition of everything that's happened in the traditional market. You know, gold is still hard money, Bitcoin is still hard money, and fiat was created. There was in 1907, JP Morgan was the equivalent of FTX. They bought up the banking system, and in 1910, as a result of that, met in Jekyll Island to create the Federal Reserve Act of 1913. I bet you'll see the same thing in the markets that you'll see in Bitcoin as well. There's still the core of hard money, and then you have these derivatives that sit on top of it, like fiat currencies. Everyone goes through greed cycles. You have people that don't know the history. You know, the people that just got wrecked are going to be, you know, what they're either going to exit the market or they're going to be wiser. And they're going to be the next generation that are going to be warning people in the next cycle. I do think that the next cycle is going to be regulated securities, though. I think we've had enough of seeing all of these things, that there's going to be innovation on terms of technology that allows you to do on-chain security law compliance, and then also centralized securities and a clearer regulatory environment. What is a security? And essentially, you'll just have Bitcoin, stable coins, and securities.
That means the regulators are about to drop the hammer, right? For that to happen, obviously, that means that we have to assume that they've seen enough, and
there's no return to business as usual after this. This is, you know, this is billions of dollars of people's retirement funds that were that have disappeared. There's no returning to business as usual. If any of these distressed lenders think that they're just going to reopen under the same regime and try and persuade people to, you know, that's just fairyland.
I mean, David, I want to ask you then. Obviously, I mean, Coinbase is probably, I think you could argue, has been the most ahead of what could potentially be coming regulatory, obviously working, I think, pretty directly. Besides the fact that you guys tried to offer an earned product and the SEC just kind of kicked you out the door with no explanation. But does that mean that an exchange like Coinbase is well positioned for this future, I guess, environment of stricter regulation?
Yeah, I would say that definitely there's going to be more of the future that people are going to be looking at more regulated products similar to what Coinbase offers in order to do that. I think sometimes the industry kind of complains because maybe there's a price to be paid for a regulated product versus one that's not. But I would say that given the long-term strategy that Coinbase has had, you know, the fact that they follow prudent risk management, and again, you know, I don't want to be here just kind of to pump up Coinbase, but I do work for them. You know, I had to point out that we didn't have any losses from our financing book. We didn't have any exposure to any of these counterparty insolvencies. We didn't have any gating for client loans, for example. We never had any like recalls, withdrawals, changes. You know, I think that will matter, especially to institutional counterparties going forward. Now, you know, is the whole industry going to change? I think that similar to what Simon said, probably we will see more regulatory follow through, but we're probably going to start with stable coins because that's what I think a lot of these people in Congress understand first. And certainly we've seen a couple of proposals now coming from Pat Toomey, from Lummis, excuse me, Gildebrand. I don't think it's necessarily going to be tackled this year because we still have the midterm elections to kind of go through. But I think probably next year, this is going to be the first part. And then as more legislators understand what happened over the last couple of weeks with these centralized lenders, with the financing space in the crypto land, I think that maybe we'll have more thoughtful kind of regulation going forward, at least a better framework than the one that we currently have, which is very limited.
Yeah, I think if I could also add the regulator's role in this, because full disclosure, I was an investor in Coinbase when it was a private company before it went public. And Coinbase bought our US broker-dealer years ago in order to do security law compliance. And when we built that broker-dealer out and then Coinbase took it on, and years later, they still haven't been able to do the security token thing because of pushback from regulators. So I can say that, having been a shareholder in and seen, I think it was 2018 when we sold that, so 4 years later, and they still haven't been able to do something with that. So the delays from the regulatory side as well meant that companies that are trying to do this in a regulated environment in bull markets have to compete with the cowboys that are just coming along. And we've been through that in the ICO boom of 2017. You know, we were offering people equity in private companies of many of the exchanges, and no one would buy any of the equity because the ICOs were coming along and they could pump and dump them in seconds. And we got disrupted by the ICO market. Fortunately, we had Bitcoin balance sheet, which was our VC. We never needed VC funding, so we're able to ride those out. But you know, the regulatory side as well has an impact in allowing these outside of regulations operators to compete with those that are just really being punished for trying to do things the correct way.
I think we'll see in the long run, though, that doing things the correct way is going to pay off. Right. I think with Coinbase, obviously, you know, Coinbase's stock is down, but Coinbase, to David's point, was not materially impacted by anything. I think institutions will continue to trust Coinbase, whereas they're not going to trust some of these other lenders, right? And I think often in a bull market, it's, you know, it's cheap and easy to make a lot of money really fast. But if you want to build something that's sustainable and is going to last, you have to try to do things, you know, the right way within the confines of the law. I think, you know, there have been a lot of cases of, you know, companies trying to skirt regulation and just being like, oh, I will deal with that later. And I think that we are going to start to see a lot of pain for the folks that were just like, hey, you know what, it's fine that I didn't register in Wyoming or in Montana or abide by this state's law or this country's law or whatever it is. You know, I think the folks that are trying to build real, legitimate, trustworthy businesses, like Coinbase being one, Gemini being another one, NYDIG being another one as well. But I think they will benefit in the long run from this. Whereas, you know, in the short term, you know, some of these things which did try to basically say, oh, the regulators don't matter. None of this matters. We just have to build as fast as we can. And it doesn't matter if we're losing money, you know, for the next, you know, 24 months. In the long run, we're going to be okay. Right. I think those clearly it's already starting to play out that there's going to be impact on all those people.
There's a very frustrating cycle here, though, to what Simon just obviously described before, what we're discussing, which is that once again, retail gets left out, right? And so we all kind of rail against accreditation laws and people should be able to invest in what they want. And so retail goes and they use these platforms, they get absolutely destroyed. And now we're back to regulators need to protect us, and only the wealthy will have access to this yield and these products because they're securities.
It's pretty. We've been preaching for regulators for over a decade now. You know, the Jobs Act was created off the work that we did when President Obama saw the work that we did in the UK with the equity crowdfunding industry. It's pretty simple. Only invest what you can afford to lose. Force in the user experience a percentage of your net worth. Verify your net worth. Test people on their understanding of the products. And we built all these user experiences at Banks of the Future. So it doesn't need to be only the wealthy can do it. It just needs to be force the rules of sound risk management in the user interface. And if the players aren't going to do that, then get regulators to enforce that. It's just suitability, basic risk management, transparency, disclosures, and there are good regulations, and that's centered around investor protection.
I 100% agree with that and love what you're doing in that context, but that literally means we have to present that to the United States regulators and get them to change the accreditation laws based on that idea, which they've been pretty reluctant to do.
They did already. It was the Jobs Act and Regulation A+. That all came from that work. These laws do exist. Right. They just take a longer time to implement them.
Yeah. David?
No, I would just say that I'm a lot more forgiving for the retail market than maybe some others. And, you know, I have a friend, for example, who doesn't invest in the stock market, which has been around for, of course, a lot longer, primarily because she doesn't necessarily know how to track a PE ratio, for example, like these metrics that we've had for forever that we take for granted in terms of, okay, this is kind of what I need to look at. And, you know, now you're taking it to an industry where people don't necessarily familiar with technology behind it. Like if I explain to you, okay, you know what, the merge is going to happen, and that's going to combine like the beacon chain with mainnet, like before I even get to the end of that sentence, you're going to just kind of like your eyes will glaze over and just be like, I don't even know like how to invest in this space. So obviously, you know, we try to educate people, we try to break it down. But I mean, I just kind of want to respect the fact that for your average retail investor, yeah, this is still really complicated. I mean, regular markets are super complicated. So, you know, I agree with Simon. I think that this is kind of where the regulators need to step in, because people aren't necessarily going to have the time to educate themselves, or they didn't have the training or background that many of us on this call do, for example, to be able to kind of make to parse the nuances of the space the way that, you know, your average investor probably will need to do.
Yeah. I mean, it begs the question then, how should your average person who's new to crypto even approach this market at this point? Mike, I'd love your thoughts on that, actually, because what do you do if you're new and you say, listen, I want some exposure to Bitcoin or crypto? You don't understand any of the nuance. Where do you buy it? What do you do with it? I mean, what advice would you give to that cousin who's never bought this before?
Yeah, it's tough. I mean, because look, there's a huge gap between accessibility and then like really good investing, right? So like if you watch some cliff diver jumping off a cliff, or you watch somebody climbing Everest, it's might be accessible to you to do that, but you should probably know better if you're not really a climber that you probably shouldn't try to climb Everest. And I think, you know, good investing is similar. Just because Robinhood gives you an interface that's cute and colorful doesn't mean you should start trading call options on tech stocks. And, you know, most people, like 90% of people probably should know that intuitively, but some of these platforms make it so easy that you start to believe, oh, this is easy. Anybody can make money. And so like my view on this is evolving, but I think, you know, you can rely on your advisor in a similar way that you rely on your advisors in traditional markets. You know, most people don't just go in and buy stocks directly. The self-directed percentage of the population, at least in the US, is like 20-30%. The vast majority of people who are accessing the markets are using an advisor, a wealth manager. And that's exactly what Eaglebrook does, right? The whole idea of that, reason why I invested, I was the first seed investor in the company, is to provide a sort of compliant, secure platform for advisors to get their clients access to Bitcoin and crypto. And so at least there's some guardrails there, right? Like it's not perfect, but if you have a portfolio that's like 80% Bitcoin, 20% Ethereum, it's kind of hard to get your ass kicked the way some of these people are getting their ass kicked, going way off the reservation, buying Terra Luna, buying, you know, shit coins that are all going to zero.
An ETF would be nice, right?
Yeah, if the SEC would stop trying to harm consumers actively, which is my view of what's going on. I mean, Grayscale, the GBTC fund, the fact that there's like $20-30 billion in there and it hasn't been converted, it's a total travesty. And then there's these futures oriented products that have 10-15% all in fees, and they're allowed to operate. And they're short funds now. I mean, it's absolutely insane. Like, I don't know if there's a lobbyist or if there's a cultural issue, or if Gensler literally is just an evil guy. I'm not really sure what the answer is there, but it should have been approved by now, in my opinion.
Anyone else have thoughts on the ETF? Go ahead, Josh. Yeah.
I mean, the craziest thing to be on the ETF is that it's literally the same exact index as the futures ETF. Like, that's just the most ridiculous thing, right? Like, you know, they're like, oh, there's no regulated spot markets, so we're not going to do a spot ETF, but there's a regulated futures market. But the regulated futures market, like the CME, uses, you know, a reference rate, which is a combination of spot markets, and the proposed ETFs have the exact same index, like the literal exact same index and reference rates they want to use. Like, there's no difference. It boggles my mind. I think the only person who doesn't want to see an ETF is Barry Silbert, because Grayscale is making so much money from GBTC and from ETH and from all these other products. You know, like, obviously publicly they want to, you know, pretend that they want this ETF, but I think, you know, it doesn't make any sense for them. I mean, you know, with all the losses from Genesis, you know, compounded with other things going on, if an ETF were to get approved and those 300 million in revenue, you know, they weren't seeing that on the Grayscale product, I mean, that would be really bad.
Do any of you have any color on what that actually looks like, how Genesis sort of passed that loss on to the parent company?
Yeah, well, I mean,
I've seen some pretty crazy numbers.
DCG is an incredible company. It's one of the only private companies that both buys back stock every single year and pays a dividend, right? Normally, you only see that in large, really profitable, mature public companies, but this is a private company that basically, like, Barry has like a stranglehold on the stock. And because Grayscale and Genesis were so profitable up until now, and Barry also has a personal stack of crypto that I believe is in the billions. yeah, I mean, it's not fun to eat $1 billion or 300 million or $500 million loss, but if there's one company in crypto that can do that fairly easily, it's DCG. And these are all 100% wholly owned subs, right? So CoinDesk prints something like $50 million a year, just net income to the bottom line, right? Grayscale was doing, up until recently, was doing like 100 million, right, plus in revenues, right? The Foundry business was doing fine, right? Foundry doesn't
I
take
think
any
Grayscale
directional
was
risk.
doing, if you look at what they were charging at Bitcoin's high, I think they were probably doing about
It's more like
800 million annually.
Yeah, it was more because it was 2% on like 50 billion, so it's close to $1 billion of revenue. Yeah. So yeah, I mean, like that's why he's able to buy back all that stock, and so he's a smart guy. Like I'm not worried about any of the DCG.
No, I'm not. I'm totally in agreement with you. 100%.
Yeah, I think it was to my question, which is that we're seeing people say, listen, like they just ate a bigger, like they ate a bigger loss from Genesis than their entire profit for X many years, right? I mean, it's a lot of money.
Yeah. I think what we're saying is that essentially they've had a subsidy from regulators by not approving the spot ETF. And so, you know, the industry has been left with this horrific project, which you know, really can't track Bitcoin, that has been left in people's retirement plans for high net worth people. And then the next iteration was they created the futures ETFs, when everyone just wants the spot ETF, and regulators have essentially subsidized that horrific product, to the detriment of consumers. That turned out that those arbitrages gone wrong, blew up hedge funds that had under collateralized loans with all the lending companies, that has caused massive liquidations. So if you go through the flow, these consequences of not approving that spot ETF has really cost the consumer an incredible amount of money, and given a subsidy to monopoly institutions for bad, inferior products. Regulations have failed.
Yeah, I mean, I think, again, retail is screwed. Like, it's just another example. Like, all the funds that lost money on that trade, that's your own responsibility. Everyone knew the risk there, right? Anyone who was doing let me go borrow money, let me basically buy shares of GBTC and borrow Bitcoin or whatever the trade was, they all knew the risk, right? But it's retail that was buying GBTC at a 200% premium, and now it's trading at a 30 to 40% discount. They're who got screwed again, right? And I think, the SEC is supposed to protect consumers, and consumers are the one, because of what happened with Celsius, because of what's happened with GBTC.
Sorry, retail can't buy GBTC, can they?
No, they can. They buy it on the market.
Oh, yeah, you can buy it.
Fidelity.
Go into E-Trade and buy GBTC. Yeah, absolutely.
Right. I mean, those are the ones that are totally screwed, because they're the ones that are buying it. I mean, that was the exit liquidity on that trade, right? The exit liquidity was the retail. It was, hey, I'm basically going to arb this trade and dump on retail 6 months later when that lockup period ends. Originally it was 12 months later. And then all the retail guys, when you log on to Fidelity and you type in Bitcoin, it's going to pull up GBTC. Some of them probably didn't even know better what they were buying. They were buying that GBTC. I mean, there had to be that exit liquidity at the 200, 300% premium to NAV. In some cases, these other products, like their Litecoin product, were trading at a 500% premium to NAV. Granted, these are smaller products, but retail got absolutely destroyed again.
Oh, that's primarily because they had a captive audience in order to exploit. And I think that from the SEC and these executive agencies kind of perspective, I think it's remarkable timing that they approved that futures Bitcoin ETF like almost at the peak of Bitcoin prices, and then they just approved the Bitcoin short futures ETF just when we're seen to be at the lows of Bitcoin. So it's remarkable timing that these guys are kind of picking on. And I think in a lot of ways, I agree with you. It's just easier for them to rationalize, hey, this is a cash product versus, or a cash settled product, versus having to actually justify Bitcoin spot ETF, which, for various reasons, I guess they find somewhat more complicated, even though it doesn't necessarily make sense. And they aren't considering the cost of the roll, and they aren't considering the pass through to the consumer of having to pay for that roll, for example, which is really the problem here. And, I agree with you. I just don't think they're actually protecting anyone by doing this. In fact, if anything, the timing seems horrible for what they're doing, both on the short side as well as the long side.
But yeah, to what you said before, that of course retail gets left holding the bag here, and people know the risks if they're institutions. But BlockFi almost exploded and destroyed retail. People seem to forget only about a year ago, right, when the GBTC premium turned into a discount and they failed on that trade. They needed to do a funding round. They've managed to sort of skirt around, like I don't know, they're doing a definitely an evil Knievel jumping over 100 cars to continue to survive here. But it did almost pass down to retail directly, even with the responsible fiduciaries that were handling it, right?
Yeah, I mean, I talk about that a lot. The BlockFi grayscale trade was one of the early warning signs that this yield product, retail facing yield product, wasn't going to work at scale. And that was when I started to dig into both what Celsius and BlockFi were doing. And BlockFi survived by essentially wiping out their equity investors, right? They survived by maintaining some confidence in the market. They paid that $100 million SEC fine. They basically cleaned things up and they stopped the shenanigans just before things really got worse. And Alex Mashinsky, because he had no adult supervision, no real corporate governance, nobody looking over his shoulder, was allowed to continue running amok until he blew the whole thing up. And that's the only difference. Like Zach, the CEO of BlockFi, is not a bad person, but he was wholly inept to run this business. They had no risk management frameworks in place. They had no skilled people looking at the book in the spring of last year when they started to blow up. The difference, again, is that he realized that earlier, whereas Mashinsky, up until literally the day they shut down withdrawals, was still pretending like he knew what he was doing. Zach at least raised his hand, probably went to his board at some point and said, I'm way the fuck over my head. I have no fucking idea what I'm doing. I'm about to blow this company up. Please help me. And Mashinsky literally doesn't know how to do that. Like, he's just incapable of recognizing his own issues.
Yeah, I think it's going to be actually very interesting to see in this environment of sort of this lack of trust and yield, since BlockFi has clearly risen sort of from the ashes of this, whether people continue to trust them or any of these other platforms. And somehow, guys, we arrived at 10:30.
Well, BlockFi isn't BlockFi; they're FTX.
Good point.
So you've got a 30-year-old speculator that became a billionaire on shitcoins, that's going around countries like El Salvador, persuading them not to use Bitcoin as legal tender and trying to get them to launch a shitcoin, and going around Central Republic Africa, telling them that they should launch these shitcoins. And this is the guy that owns BlockFi. So, you know, you've got these completely irresponsible people that bailed out the industry. That's where it is now. That's the state of play. You got somebody that became a very fast billionaire through all the things that shouldn't make people rich, that got rich quick, that is now the person that's in charge of all these companies.
Needless to say, it's going to be a very interesting few months and years, I would say, moving forward. And I got to let you guys go. So thank you, David, Simon, Josh, Mike, guys. Absolutely amazing conversation. Always appreciate you showing up and taking the time. We're going to see if the outro music will actually play. It's going to be a challenge. We might actually just sit here awkwardly while nothing happens. But guys, just so everyone knows, I will be off tomorrow. There will be no live stream. So I'll see you guys on Monday. Thank you guys once again. Peace.
That's dope.